Hello and welcome to the Stockout. This is your show at Freight Waves for all things related to CPGs. Those are consumer packaged goods and their supply chains. I'm your host, Mike Bowden-Distel. I'm the head of Intermodal Solutions here at Freight Waves and also follow the CPG industry. So if you're following, coming to us from another show at Freight Waves, that's what's different about this one. We do have about 20 others. More than anyone could possibly digest, but we try to get them specialized enough that you can find an area that you're really is focused on. Today, we're going to talk a lot about the stock volatility in the CPG space, sort of who says that CPG stocks are boring. Tyson is down about 8%. Treehouse Foods is up about 5%. So we'll talk about what's happening with those companies that both reported earnings this morning and their stocks, and also talk with the guys from the Smart Cube, a company that I'm interested to have on. They combine AI and market expertise, sort of in a manner that seems at least somewhat similar to what we do here at Freight Wave. So we're going to be talking to them about what they do for the CPG industry and what's happening in the CPG space. So we'll do that today. But first, ad from RJW Group, which is sponsoring this podcast. They should say RJW owns and operates every step of the middle mile. As an asset-based integrated logistics company, they offer a full suite of retail supply chain solutions under one roof, including industry-leading retail consolidation that consistently delivers over 98% on time and in full month after month to many retailers. RJW's programs offer suppliers control and transparency, helping them improve in-stocks, achieve retailer compliance, grow market share, and increase sales. Visit rjw.com to optimize your supply chain today. So big thanks to RJW Group. And before I introduce the guys from the Smart Cube, I'll talk a little bit about what's happening in the world of CPG news today. Tyson Foods, have a stock chart there on Tyson Foods, which has been a volatile one. Shares are down about 8% today. And basically, this has been one that's been really interesting to watch sort of throughout the pandemic. You see there at the left part of that chart, shares absolutely fell off a cliff at the beginning of the pandemic. They had a hard time, keeping products on shelves. There were, people in their facilities too close together, during the height of the pandemic, and really almost got cut. Shares almost got cut in half, and they almost doubled, back to where they were and higher. Company was really able to take prices up sort of throughout the past couple of years. A lot of times they were increasing their prices for meat 20, 30, 40%. Really based on market conditions, and they had such strong profits that drew the ire of the Biden administration, which seemed to be convinced that the meat processors were in collusion. Nothing else could explain the fact that prices for meat were soaring so much and profits were increasing so much. Well, this may be is counter to the administration's argument, which is what happened today. Basically, volume for Tyson's meat dropped in their second quarter, or I guess most recent quarter, 1.9%. That's with prices that are still rising, increased 1.8%. Companies sold less beef, down 1.5%, less pork, down 2%. And the mix of cuts went to lower end, cuts of meat. So this is really kind of the first indication that there's really a lot of price sensitivity in the category of meat. And we were starting to see more elasticities in more consumer packaged goods, that a lot of the companies that are increasing prices 8, 9, 10% or more, some of the CPGs are now saying maybe 15% higher, sort of something a little closer to what the meat industry had been doing the last couple of years. They're starting to see more demand destruction. Tyson's operating margin declined 80 basis points from 8.5% a year ago to 7.7%. So, kind of flat profits, despite the fact that sales were rising about 8%, higher cost pressures for wages, animal feed, and transportation costs, which, we've talked a lot on Freight Waves about falling spot rates. Big company like that is still participating in the contract market, doesn't do a lot of spot activity. Those rates are still higher year over year. So transportation costs are still a headwind for big companies like Tyson. The next company I'll talk about is Treehouse Foods. Treehouse kind of going the other way today, up 5%. And you see their stock, which has actually been quite volatile the last couple years, sort of throughout the pandemic. Treehouse Foods is a company that makes food that is for private label. So think of companies like Trader Joe's or Aldi that have a lot of their food as the store brands. They're the manufacturer for a lot of that food. And during the pandemic, there was a big shift from private label to the national brands. It seemed to give consumers a little bit more comfort to have those nationwide brands. It also seemed like the consumers had more discretionary income to spend. That sort of turned the other way here, with consumers more interested in saving money, and the savings rate is now dipped below pre-pandemic levels. So private label seems to be doing really well. In the second quarter, private label brands had 15% sales growth on 2% volume growth. So it sort of implies 13% pricing in the second quarter. So quite a lot. The national brands in comparison had 9% sales growth on a 5% volume decline. So interesting that in second quarter, 2% growth in volume for private label, national brands a 5% volume decline. So you're sort of seeing maybe demand destruction overall in CPG, but also some of that shift from the national brands to the private label brands. Treehouse Food also has a good graphic on the gap in pricing on average between the national brands and the private label, which is currently tracking about 31 to 32%. And what's typical is something in the range of 26% to 30%. So they're making the argument that even though that most recent quarter, private label brands increased price about 13%, there's still room to rise when you compare that to the national brands, at least on a percent basis. So so sales are good at a company like Treehouse. Still seeing margin pressure. Their adjusted EBITDA margin went from 9.2% in the year ago period to 5.6%. Company says that's in line with expectations, but still a lot of margin pressure there, which I think has been really true throughout the CPG industry. They really haven't gotten back to the pre-pandemic levels for most CPG companies, maybe with the exception of meat, which has really had strong margins. Today's Tyson results notwithstanding. So that's just as a little bit of an update. I'll do one quick additional an ad by RJW Group. So RJW Logistics, if we can get their logo back on the screen. Are you assessing the advantages of prepaid versus collect freight management for delivery into retail? RJW's retail consolidation program consistently achieves over 98% on time and in full to ensure a stronger shelf presence, increased in-stocks, retailer compliance, and overall retail supply chain improvement. Visit rjwgroup.com and speak with a retail logistics expert about the advantages of RJW's program and to make the best decisions for your business. So thanks again to RJW Logistics Group. And with that, would like to bring on today's guests from the Smart Cube. If we could do that. So from the Smart Cube, thanks for joining me, gentlemen. We have Nitin Agarawal. I'm sorry if I'm mispronouncing that name. Most people mispronounce my name.
That's
so.
good, Mike.
Okay, and Ashish Kumar. So Nitin is the VP and Business Head of Analytics and Data Science at the Smart Cube. And Ashish Kumar is a Senior Analyst at the Smart Cube. So a lot of brain power here that's going to talk about data. And the Smart Cube, sort of interested to hear. Sort of you just described the company. You sort of described it on the website as kind of bringing AI combined with market intelligence from people who have really lived that business out in the field. But I want to hear from you just kind of your description in your own words.
Sure, absolutely. So the Smart Cube is a global analytics company. I can simply describe it as we help companies, especially CPG firms and retailers, reduce costs or increase revenues using data. And we do that by combining the best of AI, artificial intelligence, and HI, which is human intelligence, to answer some of the most critical and pressing business questions that executives face in these companies.
Yeah, that makes a lot of sense. I mean, it's really right now, so many of these companies are trying to reduce costs. They don't want to just fully, they have so many cost pressures all sort of across the board. It's hard to fully pass those on with price increases. I think consumers are maybe starting to revolt a little bit. Can you walk us through maybe an example of a way you've helped a CPG company improve their cost efficiency?
Sure. So the Smart Cube, Mike, we look at efficiency through two different lenses. One is from the demand side and the other is from the supply side. I'll actually talk about it from a demand side, and my colleague Ashish we'll cover it from the cost side or the supply side. So from the demand side, there are multiple ways in which we help CPG companies improve their efficiencies. It could include better demand forecasting, improving efficiencies of pricing and promotion changes, optimizing the assortment, and then also moving consumers, reaching out directly to them and moving them to digital channels, either through your own brand websites or partnering with marketplaces or other national retailers. So those are the four broad areas through which, or levers that companies have from a demand perspective to help improve efficiency. And I'll talk about one example, which is demand forecasting. So one of the largest fresh food producers in the world was grappling with significant volatility in demand due to COVID. The problem was further accentuated given the fact that it was fresh produce, so shorter shelf life. And also, they also saw a big change in channel throughput. So, as restrictions were put in or stores were closed, people or consumers actually shifted to buying on digital channels or e-commerce, and which was again something that they hadn't planned for. Now, historically, a company would use historical data, or typically a company would use historical data to predict, what demand is expected in the future. However, an event like COVID hasn't really happened, so the historical data is of limited value. So what we did was we brought in a lot of external data, which is not just macroeconomic indicators, but like weather and GDP growth and what have you, but also things around mobility index. So how is COVID progressing? What are the store closures looking like, and how does it vary across regions? That then coupled with intel from the market, so trying to understand what the account managers were actually seeing from talking to their customers was also very interesting. And then more importantly, we also factored in data which is available through syndicated data providers, which tells what are the consumers' purchase intentions. So are there categories which consumers expect to spend more or less on across what time horizon, and then building all of that into the forecasting models helped develop very granular and accurate demand forecasts, which then allowed the CPG company to be able to simulate different scenarios and be able to be nimble in responding to changing demand and sensing what is going to happen in the future. So and that basically became pivotal and centerpiece to their entire S&OP process, as well as their financial and and budgeting process. So that's just one way in which we've helped CPG companies improve their efficiencies, again from a demand perspective, and maybe Ashish can cover it from the cost side or from the supply side.
Oh, absolutely. Thanks, Mike, for having us here. So, talking about the smart queue from the, let's say, the supply side or procurement side of things, we support organizations in three primarily solution areas. One is category intelligence or market intelligence, which is understanding. And the reason I'm telling you all of this is because all of this is catering towards getting better efficiency. So it's about understanding better categories and understanding your categories better from the supply perspective, from understanding what's new, what are the disruptive trends, what are the new sourcing regions, and who are the new suppliers that are emerging in this space, and how should I manage them. The second is about commodity intelligence. So specifically for CPG, be it direct categories or indirect categories, a lot of them are underlying commodities ultimately from the raw material perspective. So understanding what is happening on those commodity markets, and more importantly, predicting what's going to happen in those commodity markets. And third, from the efficiency perspective, is understanding from the supplier risk perspective as well. So again, a lot of proactive monitoring on what's going to happen to those suppliers in months to come across, let's say, different parameters from financial stability, business stability, and ESG perspective. Now, talking about one of the examples that comes to my mind is that we've supported a very large confectionery slash processed food organization where they were looking to understand that some of the key ingredients that they're buying are in short supply, and they are one of the largest consumers of those food ingredients. But ultimately, due to the changing dynamic nature of the food consumption or led by consumers, there has been there has been, let's say, a conflict in terms of how many other organizations are also willing to pay a higher price for those food ingredients. So they essentially wanted to know that if I am buying these ingredients from sourcing region XYZ, again, due to confidentiality reason, we are not disclosing that. But they wanted to know that are there more sourcing regions that are available, and maybe they're not producing the food ingredients like to like, but maybe a version of that which can be then swapped out in their current production manufacturing methods. That's one. Not only that, they were trying to understand that how can they source these categories better? What are the larger contracting best practices that they should adapt and or they should adopt about, and so that they're securing long-term supply and they're not facing the same pressures that they're facing right now because, let's say, changing consumer demand and changing supply or demand side dynamics. And thirdly, they wanted to understand that how can we model the cost better so that we are not paying a premium because we are one of the largest consumers of these food ingredients. Then how can we understand the cost a little better so that the price that we are paying for these commodities or these underlying food ingredients are the best in class from our perspective because they are the largest consumer, so they ideally should get best pricing on that. So the Smart Cube supported the entire value chain of about understanding the category, understanding the underlying commodity, understanding the supply regions, understanding the alternatives, and understanding the new sources of supply, so that ultimately they are able to take more data-driven decisions.
Yeah, that makes a lot of sense. And I can't think of another time where those things are more critical than kind of right now, with just a lot of demand uncertainty, as well as just costs rising across the board for all these companies. So just trying to get ahead of those trends, I think is really critical. And you also touched on something that we've seen here at FreightWaves, is that the historical data just really was not helpful during COVID. It just really didn't tell you what was going to happen because you hadn't experienced anything like that before. So you need to really have sort of the most real-time data, and to have people who could, sort of have the right, networks in place and all those things to really figure out what was happening. Also wanted to ask you, I mean, in your demand forecasting specifically, what categories of CPG do you think are most vulnerable to elasticities right now, sort of consumers cutting back in response to these higher prices? I wanted to ask you guys that.
Yeah, it's the classic, staples versus discretionary. That's where the answer lies. So one would assume that the consumer staples are more insulated, and the the demand is slightly more inelastic, which is true. However, and as you pointed, Mike, at the beginning of the show, we would be seeing at Tyson Foods, right? So prices for milk, egg, and then meat is rising, double-digit price inflation. So while consumers are continuing to purchase these products, of course, the couple of things that we're seeing. One is consumers are perhaps cutting down on their eating out and increasing home cooking. So which means technically there should be higher demand for some of these the consumer staples. However, they are expected to and continue to trade down from national brands to more value brands and private labels. That's one. And then second, also in terms of the pack sizes. So we've also seen that consumers are preferring more value packs where the unit economics are better for them, and also they're better for the CPG company. So those are really a couple of trends or that we've seen on the staple side. So insulated to a certain extent because price, it's still demand is still inelastic, but some changing consumer behavior there. In terms of discretionary, again, it's I think that's where it gets a little more challenging. There clearly are categories which we expect that consumers will either cut down their spending or stop their buying, or maybe move to some other categories or substitutes. But again, categories like apparel and dining and home improvements and decor, I think these will be definitely more impacted, and hence because these categories, it's also much more price elastic. I think consumers will do more deal hunting and will buy when promotions are running. So CPG companies need to be very smart around what kind of pricing and promotion changes are they running on the discretionary spend categories to make sure that the margin erosion is not very high.
Yeah, that makes a lot of sense. And maybe for Ashish, when you think about these companies trying to mitigate inflation and maybe layer in some hedges to protect against this rising input costs, I mean, how do they use the smart cube or AI or any of the data to decide how aggressive to be on hedging or finding alternate suppliers?
Absolutely. So, Mike, actually, inflation is right front and center of every CPG company that we are talking to. And to be honest, it's not only how they are leveraging the smart cube, it's about how they are trying to leverage technology and analytics. Those are the two crucial roles because the raw material prices are what the raw material prices are. But now what they can do is that can they better predict what the raw material prices are going to be? And can they be smarter in terms of how their contracts with their key suppliers are structured? And this is where part of that amalgamation of internal and external intelligence is coming into picture. Now, talking about where they are coming into the SmartCube or how SmartCube is supporting them is looking internally first. So looking at their internal supplier structure data. Well, when I say about supplier data, it is all about understanding that how their contracts are structured, which of these contracts are linked with what type of indices, and what is the volatility that these indices have had, right? So understanding the internal data first and understanding or getting visibility into the cost elements. So because when you look at the semi-finished good or a finished good, there are several ways that you can slice and dice a cost model, right? And creating an understanding that what is the freight cost, like we talked about, what is the labor cost, what is the raw material cost, what is the margin that my supplier will have, and specifically for these national brands which are getting into a lot of contract manufacturing and external manufacturing. It's very important to understand the dynamic should cost, or even for some raw materials that they're buying. And thirdly, it is the most important part where the smart cube is also coming into picture is predicting and forecasting the raw material prices. So it's about understanding that how my packaging, wheat, sugar, agri commodities, non-agri commodities, what is going to be the price forecast for not 3 months, 6 months, but maybe 9 months, 12 months, 15 months down the line, so that I can understand that if my overall category cost is X, then based on these macroeconomic factors, and this is actually very sophisticated modeling that is conducted on these commodities. These are basically macroeconomic based price models to understand that if my category cost is X, then based on these factors, will I be paying X plus delta X or will I be paying X plus Y, right? And it is also about understanding the consumer demand. So like what Nitin talked about briefly right now is about discretionary versus staple. But some of the consumer demand is changing, and which means that the underlying raw materials that are required for the meeting that consumer demand is changing as well. So the CPG companies are also getting smarter that can I swap out some of these raw materials instead of buying palm oil? Can I use canola oil? Can I use sunflower oil? Because these are going to be more cost effective for me from the long term perspective. Now, this is not easy. R&D teams and supply chain and procurement teams and manufacturing teams all need to work together. And I will also say that it is not about doing it as a one time exercise. And because right now there is just too much high inflation, then let me do this exercise and then sleep over it. Some of the larger CPG brands are becoming smarter by making it as part of their organizational procurement culture, which is not to do this now, but do this time and again. And that can be on a weekly, monthly, quarterly basis, depending on the organization's appetite. And more importantly, what type of commodities do they have volatility towards? So I would say it's a combination of internal data, external data, a lot of artificial intelligence and machine learning modeling to help combat inflationary pressures.
Yeah, that was a great answer. I mean, it's really kind of the palm oil thing has been really interesting, hasn't it? It's the war in Ukraine just impacted so many different things, and it's like palm oil is not something you necessarily were focused on until this year, but learning about all the things that it goes into, it's like everything from like Oreo cookies to personal care products to ice cream, and they've had to sort of scramble to find enough supplies there. We're about out of time. How can folks, reach out to you if they have more questions or want to get in touch?
I think one of the best ways is
Go ahead, Ashish.
So I think one of the best ways is through our website. So we are reachable on www.thesmartcube.com. That's one. And the second is that we are always participating in different, let's say, conferences, which are for respective sectors. So Latin participates in a lot of these conferences, which are related to the consumer demand perspective, and I participate in the procurement and supply chain. So those are great outlets as well. Latin, do you want to add?
Yeah, no, I think that covers, Ashish. Thanks.
Yep.
Okay, well, thanks very much, Nitin and Ashish. If anyone needs anything from me, you can reach out at mbowdendistel@freightwaves.com or sign up for my newsletter at freightwaves.com /the Stockout. Hope everyone has a great Monday.